Okay, hi everybody. Welcome to April's edition of Ascentis TV. I'm joined as usual by Mark Overend in Tax.
Hi.
Hi Mark, and I've got Lee Kosnowski from Financial Mastery. How are you doing, Lee?
Hi John. Yeah, good, thank you.
Very nice new haircut. You must have been one of the first guys in the salon, weren't you?
Very much first in the queue. Yeah, needed to get rid of all that hair. Not a big fan of long hair, so shot back inside.
Very smart. So let's jump straight into it as usual. The big change, I think, from last month to this is that we've said goodbye to C bills and B bills. That ended on 31st of March, Lee?
Yeah.
We've got a new scheme that started on the 6th of April. Have you heard of any clients actually getting any money through yet?
No money yet. No, not that I've heard. Application stage maybe, but that does depend on the lender as well.
Yeah, I jumped into the back of the British Business Bank's website just before we started this episode today, and there's about 20 lenders in there. I mean, when you looked at it when it was C bills and B bills, obviously there was dozens and dozens and dozens, but the British Business Bank have made them all reapply again to qualify for the new recovery loan scheme. And I guess the main provider that's missing from there still surprisingly is Funding Circle. Spoke to those guys this morning and they think that they won't be accredited for another couple of weeks. Spoke to Barclays as well this morning and they've got thousands of applications in that they're actually processing now, but I think a lot of them haven't been transferred yet. The funds haven't been transferred simply because of the size of the backlog from C bills as people rush for that 31st of March deadline.
Yeah, people are still waiting for those applications to go through for the C bills, aren't they? So
they haven't transferred all the money out yet. You just had to have the applications in there as well. So I'll just give a quick summary of what the recovery loan scheme looks like, and it's actually really similar to the C bill scheme. It's 25 grand to 10 million borrowing. There is some borrowing between 1,000 and 25 grand for asset finance, but the main people are going to be applying for this are going to be going for a loan. 6-year term as usual, and the major difference is that there is no interest-free period for the first 12 months, and you've got to pick the fees up. You've got to pay for your own bank arrangement fee. So that's going to vary from lender to lender. Apart from that, the criteria is very much the same. Maximum of £10 million, subject to the 25% of your turnover or twice your payroll bill. Both of those figures taken from 2019, the last time you had a reasonable set, or normal, should I say, set of accounts to look at. So we'll keep you posted on how things are going with applications in the incoming episodes. For now, I think we're going to jump straight into Tech Talk. And Tech Talk this month is actually Emma Greensmith, who is interviewing Telleroo. And Emma's going to be explaining how you can save about 80% of your time in processing supplier payments and how it can be more secure.
Hello, I'd like to welcome Andrew from Telleroo, who's very kindly agreed to join us today to tell us more about their amazing payment service. So, Andrew, would you like to tell us a bit about Telleroo?
So Telleroo enables in-house and external finance teams to make payments really simply. You can connect it up to Xero, and we can bring in the payments without you having to do any manually keying in anything or validating pays. Everything's handled on behalf of yourselves.
Fantastic. That sounds like it could be really efficient and very useful to our clients. What situations might the service be most useful?
If you have a lot of supplier payments or a lot of supplier payments that are changing regularly, even when you get to about maybe 10 to 20 payments a month, it's taking up maybe 1 or 2 hours of your month, and that can be reduced straight down to about 5 minutes with Telleroo, which is great. You have added approval processes in there, you have the validations as well, so you're really, really confident when you're making these payments that they are going out perfectly and they're taking you 80% less time.
for that. So we're a Zero Gold partner, and it's really important to us that Telleroo would work well with Zero. Is that the case?
Yeah. So what we've got is we've got a app on the Zero marketplace, and we not only are able to pick up your payments that you mark as paid in Zero and pull it into your account in Telleroo, but also if you make any changes in Telleroo, let's say, for example, you cancel a payment or you decide you don't want to pay something, we update Telleroo, update Zero, sorry. So you've got a nice two-way sync there. And that means that you're not having to repeat any work, and you're not going to get any suppliers ringing you up going, hey, I haven't been paid, and it shows in Zero that they have been paid. We're avoiding all this, and we're going to be building on top of this integration and making it even better in the coming future as well.
Oh, that sounds fantastic. I mean, we're already finding that Telleroo is very time saving, and we enjoy using it. We're very aware that you make a lot of updates and improvements, which really helps us. And we're always excited to see what you'll be bringing next. Why should our clients choose Telleroo rather than perhaps another method of payment, bulk payments provider?
Yeah, it's the simplicity. We're all about keeping the amount of time that you spend in Telleroo to a minimum. So any feature that we release, we're actually always monitoring, for example, how long someone stays in the app. And if it increases the time, then we know we've kind of failed our job, because we're always trying to keep it really, really short. We don't want you sat there for an hour doing payments, keying it all in. We're all about, let's reduce that time right down to a minimum. And like I said, it's about 5 minutes per pay run, which is massively down when the average right now, I think, is like 2 to 3 hours when people are just keying in payments for 20 payees or bills, for example.
Exactly. I mean, just think of all the things that business owners or the person responsible making for the payment can be doing with that time rather than just making payments.
Yeah, and that's it. And people just expect that that's the way it is. When you're a business owner or even in the finance department, you just think, oh, okay, I've got to make payments and it's 2 hours of my life, and I've just got to expect that. But it's not the way. There's a really easy way, and you can automate that all. Get rid of all payment anxiety, which is, I mean, any payment that I make, I always feel, oh my God, am I sending it to the right bank details? Is this the right amount? But you don't have to worry about any of that because it's all automated, and we'll flag, any of those high risk changes that happen, like a new payee or an updated payee's details as well. This all gets flagged to you in there.
That all sounds really good. So we've talked about supplier payments. Can any other payments be made through Telleroo?
Yeah, so we're connected to Zero mostly at the moment, but we're also going to be integrating with Zero Payroll, and that means that you'll be able to sync the payroll directly into Telleroo without having to use a file export from Zero. Right now, you can actually just export a file from inside Zero, but like I said, this payroll sync is coming probably in the next 2 weeks, which is really good. So by the end of April, that'll be out. And then for your expenses, they can be treated like bills in Zero. So again, you can pay them through Telleroo using that auto sync. And then any other payments, we actually have a custom CSV. It's really simple. You've just got your amount, account number, sort code, and reference in the CSV, and you can just import it that way. So this can be a HMRC payment. You can set it up on behalf of your client, which is really nice. So they don't have to worry about the reference or the amounts being wrong, which is, I mean, I don't understand HMRC payments, and I'm like, I'm glad I don't have to handle these anymore, because I always panic whenever I try and send them. So this handles everything, which is great.
So you've alluded to the changes in the payroll payment service that will be coming up, but can you give us any sort of exciting hints, just for our clients and listeners, that might be happening soon?
Yeah, so we're looking, and it's in development right now, a kind of more sophisticated monitoring platform for the accountant for Zero. So that'll be looking into more like kind of AI and machine learning into fraud. So, even spotting something before it even gets created as a payment. We'll be able to, for example, validate bank details in Xero before they even get put into Telleroo. So we're now going from less of a reactive approach to proactive and basically flagging things before they even happen. And that should give you even more confidence when you're making payments through Telleroo, because before they're even in Telleroo, everything should be perfect. And all of these high-risk changes will be flagged to you straight away.
No, that sounds fantastic.
It'll be good. I think, obviously I don't want to go into too much detail, but it should see a massive reduction in any time spent. If someone types in the wrong bank details and there's a bounce payment, that still costs a lot of money for your firm and also for the clients if they're doing it. So we're all about, reducing the amount of time spent on payments. And that's our real core goal here. So with that feature, we should be able to really reduce that down and also get rid of the main thing, which is the payment anxiety that everybody always experiences with sending payments. So if we can get rid of that completely, then I think that's kind of achieved our mission and our goal.
Fantastic. It feels like you're going a long way towards that already, and we can't wait to see the changes that will come through in the weeks and months to follow. Yeah.
We're really excited. The whole team is, we're trying to think a bit out of the box, and we're not trying to do what everyone else is doing. And we spend maybe a bit longer building stuff, but when we release it, we really hope with all the testing that we're doing with different users that it really does make a big difference to the whole finance function and really reducing all of that time. It really makes us happy when we hear people say, you've actually saved us, 2 hours every week of our lives, which is great.
Fantastic. Really making a difference to people.
Yeah, exactly. In payments, one payment at a time.
Yeah. Great. Well, thank you very much for your time, Andrew, today. And we'll look forward to working with you going forward and introducing more of our clients to you as time goes on.
So, Mark, Emma talking there about this new upcoming feature to Telleroo, which is the ability to pay your wages straight out of Xero and expenses. That's good. That's going to be a huge time saving as well.
Yeah, speaking selfishly from a payroll point of view, one of the biggest bugbears amongst the client base is, having to key wages payments into their bank, at short notice. If they're up against it, it's time consuming. And, of course, it's potentially subject to errors as well. It's very easy just to miskey a wage, accidentally pay somebody the wrong amount, and then you've got to go through the process of either, an employee getting upset at being paid the wrong amount, being paid too little, or trying to get them to repay the overpayment. So, yeah, to automate those payments in such a way will be fantastic. I think everybody be delighted to be able to use that piece of software to do that.
And changes in employees' bank details as well is something that can cause problems as well. If they're often there's a disconnect between that going to the payroll department, and quite often the people that actually pay payroll are different to the ones that process it, but the message doesn't get transferred, does it?
No, exactly. So, you put the pay details into Xero, and then it's going to be fed through on the feeds. You basically, if you're using My Payroll as part of the Xero package, the portal where the employees can manage their information, you can almost make it an automated system. Get them
just getting human involvement out, isn't it? The more it's automated, the less errors are going to be there. Okay, so anybody who wants to explore Telleroo, Emma or a couple of other guys, think Lee, you've got a pretty good handle on that. Happy to do a demo and talk people through how it'll work.
Sure, yeah.
Cool. Okay, just get in touch with the office. Okay, we're going to jump now into it's back to basics time. Last time I did a profit and loss account, and I did kind of caveat that by saying how simple it was. And we're going to do exactly the same thing with the balance sheet as well. We'll build up the complexity in future episodes. We'll keep the consistency until we get through these 3 basic statements of profit and loss account, balance sheet, and cash flow by having these really, really simple examples. So here we go. Hi, everybody, and welcome to back to basics. This month, we are going to be looking at the balance sheet. Yes, you can see a profit and loss account in front of you there. That's my little baked bean factory example that I gave you last time. So if you missed that video, jump back onto the prior episode. So moving on to the balance sheet, I'm going to use the same methodology that we used in trying to understand what a balance sheet is by referring to your personal life. Because in the same way that in episode 1 of Back to Basics that I described that you'd done a profit and loss account by driving home and thinking about the amount of money that you'd earned that month, and then mentally knocking off all of the costs that you've got to arrive at effectively a personal profit, you would do exactly the same thing when you thought about how much you were worth. So after you've done your little profit and loss account about your income and expenditure, probably not as regular, but you would think about, what am I worth? What are my assets? What do I own and what's owed to me? And what do I owe to other people? What are my debts? And therefore, what am I worth? So here's a simple example of a personal balance sheet. Car, a watch, antique, shares, building society, bank account, all worth money to me in my little example here. And I've got just over £18,000 in assets, but I've got debts as well. I owe some rent, I've got my credit card bill, and I've got my HP on my car as well. But the good news is that I'm still worth just over £10,000. In fact, I'm worth, my liability, should I say, I said my debts are less than half of my assets. So I'm feeling quite pleased with myself. So what I may also do as well is think, how much am I worth immediately? What's readily available to me in terms of cash? You know, if I wanted to buy something right now, and what's the more longer term stuff that I would have to actually, liquidate my assets for? I'd have to sell my assets if I wanted to get my hands on that. So I've split it into what's readily available and what's more long term, if I had to probably sell up, completely. So things that are ready available are shares, build society and bank, and get my hands on those straight away. And of course, I've also got these short term debts that I've got to pay, my rent and my credit card. And the other stuff, my asset, my car, watch, and my antique, and my HP on the car, they're much more longer term. I don't have to pay the HP back yet, and it'd probably take me quite a while to get rid of those things. So that's my immediate, if you like, solvency, to use a business term, in the readily available. And the longer term stuff, I'm still in the black. I've still got my head above water. I'm still worth £2,500 in the long term. Let's beef those figures up before we now take this theory about personal assets and liabilities into a business world. And so I've added a few notes onto all of those figures. And then what I'm going to do is I'm going to change the format now. I'm going to change how I would do this mental balance sheet into what those figures would look like if they were in a company format. And this is how a company sets its balance sheet out. It describes those short and long-term items differently. So the assets are described as fixed assets, and they're fixed because they don't change on a daily, weekly, often annual basis. And the things that are more short-term are called current. So they're my current assets. That's things that I own or are owed to me. In my case, my shares, building society and bank account. And those that I immediately have to pay out as well, my immediate debts, my rent and my credit card. My long-term debt, which is my hire purchase, is now down in an amount falling due after more than 1 year. This is exactly how businesses set out a balance sheet. And the reason that we divide these, that we divide the assets and liabilities up into these headings is in the same way that I showed you in the profit and loss account. It's because of the way that they behave. Current assets and current liabilities change on a daily basis. And that's why you compare one to another, because you want to know how much money have you got to meet the immediate debts in the business. Let's just jump it into a business format as well, shall we, so that these descriptions become more meaningful. So I've changed it now. The figures are the same, but I've changed it into more business-like descriptions that you'll be familiar with these from looking at your own balance sheets. So once again, why does the current assets sit next to the current liabilities? Why are the current assets and the fixed assets added together to produce a total assets figure? Because that figure's It's not totally meaningless, and I'll show you why in a moment. But it's nowhere near as useful for the reader to understand the strength of this balance sheet, because a major factor or a major aspect of understanding that a reader needs to know is how safe is the business. And from a lender's point of view, from a customer's point of view, a supplier, a potential employee, the Inland Revenue, the bank or whatever, these are all what we call stakeholders in your businesses, deciding whether they want to buy from you, sell to you, lend to you, work for you, provide you with finance. They're stakeholders. They don't have an upside in the business. If you make £10 million, that's not going to affect them. If you lose £10,000, then they are going to be really worried, because that presents a risk to them that either they're not going to get their money back, you're not going to fulfill their order, they might not get paid as an employee, or they won't get their loan back if they're a financier. So that's why they have a focus when they look at the balance sheet, not on the upside of your profitability, but on the downside. In other words, risk. They focus on risk. And one of the key things that they look at straight away is the liquidity of the business, and the solvency, if you like, of the business. Is the business solvent? And in its quickest and shortest definition, solvency means, can I pay my debts as and when they fall due? That's why we compare current assets to current liabilities. Because if all of your creditors in the short term, that means the ones that you don't have long term for, you haven't got years to repay it back, they're pretty much repayable on demand. Yes, you've got 30 days with your suppliers, and you've got a month to pay the pay as you earn and a quarter to pay the VAT. I get that. But the concept is that they are very short term liabilities. And if all of those liabilities became due, how would you pay them? You would have to obviously pay them from your current assets. That's why the two are compared next to one another, and the net current assets figure here is presented. You'll also notice that I've put some comparisons down here just to put it in that familiar business format. The net current assets, obviously, it's the amount of current assets over and above current liabilities. Or indeed, if you had less assets than liabilities, you'd have net current liabilities. And technically then, that business is insolvent. Now, how do we measure this relationship and compare it to other businesses in the same sector or other businesses in different sectors you may prefer to lend to? And how is the business performing year on year? Well, again, I'm going to show you a couple of KPIs relating to risk. And the first one that we're talking about is the current ratio. The current ratio is really simple to understand. As you've described, that is your ability to pay all of your liabilities if they fell due now from your current assets. And it's really simple. All you do is you take the total current assets. In my case here, this is 10 million. Forgive me, it's £1,085,000. And I've got £325,000 worth of liabilities. Divide 1 between the two, and you can see that I've got 3.34 more times in assets than I've got in liabilities. Or I've got £3.24 for every £1 of liabilities. That's how simple to calculate the current ratio is. And it probably is the key ratio that people will look at on your balance sheet, and that's why you need to understand it. Anybody that's looking, if you go onto a credit agency reference like CreditSafe UK or Experian or whatever, the current ratio is front and center and has a major impact on your credit rating. If that goes down, the risk of dealing with you goes up. So in the prior year, I've just done the same calculation, 575 grand divided by 230 grand. I had 2.5, a current ratio of 2.5, or £2.50 for every pound liabilities. So this looks like a safe business, doesn't it? The baseline is 1 to 1. I should have £1 in assets for every £1 in liabilities. That means I'm break even, if you like, in terms of assets and liabilities. The further up you go, the better. There may be some suspicion as to why it gets really high. Why on earth would you have lots of current assets in a business? You should be doing something with them. Maybe you've got too much stock. Your debtors are old. You've got too much money in the bank and you should be investing it. We'll cover these in future Back to Basics episodes. But as a minimum, it should be a positive figure. There's a second ratio that these stakeholders, these risk-averse stakeholders, look at, and that is the overall debt in the business compared to the overall assets. And this is, I guess, this is the kind of the worst case scenario. If this business goes into liquidation, will I get my money back? The first one, current ratio, answers the question, can I get my money straight away? Am I going to get paid at the end of the month on a regular basis? Does this company have really good, solid working capital to be able to look after me? The second question is, I guess, if the company goes into liquidation, will I get my money back? Well, this is where you do bring the fixed assets in. And the easiest way to understand this calculation, and it's called gearing. And the clue is in the word. It's the relationship between the total liabilities in the business. So that's going to bring in my hire purchase down here. And the total assets, adding fixed assets and current assets together. As I say, the easiest way to understand this is, imagine you had a house worth £100,000 and you have a mortgage on it of, say, £85,000. That house is 85% geared. Works exactly the same in a business. We take the total liabilities, and in this case, we've got 325 grand here and 500 grand there. So we've got 825 grand. And it expresses it against the total assets as well. And doing that calculation says that we've got 44%, nearly 45% in assets compared to liabilities. That's a fairly safe space, where I always use that 85 grand mortgage on the 100 grand house, because 85% gearing really is the upper level that you would want to see in a business. Anything above that, you can imagine that a stakeholder may look at your business and think, 85% of the assets are already encumbered. They're already represented by liabilities. If I join the party with another liability, we're going to be sending the gearing up even further. And it won't take much for the assets to dip down by 10, 15%, particularly in a forced sale, and I'm not going to get my money back. So that's kind of the sweet spot. That's the upper end, is 85% gearing. By comparison, I think you'd be scratching your head and asking a business why they've only got, say, 20, 25% gearing, because that would, using the house example, you've got all that equity. Why don't you borrow it down? Why not invest in the company, particularly if it's a profitable business in a scalable industry? Why not borrow money, invest it, double the turnover? We all know it doesn't work as easy as that, but there's the questions that may be asked. Why aren't you making more use of your assets? So there we are, a balance sheet for you, and a couple of KPIs to help you understand the basics of what somebody, a stakeholder in the business, is looking at when they view your balance sheet. Okay, I'll see you in the next episode, guys.
Loving this baked beans theme we've got going throughout this, John. Now it's time for Mark's tax tips and when is a van not a van?
Right, welcome to this month's tax planning section of Ascentis TV. We're going to focus on vehicles this month. First of all, for those of you who got the pleasure of completing P11Ds, HMRC some time ago now, but fairly recently, won a case against Coca-Cola that has probably got quite a big impact for anybody who operates a fleet or vans in their company. For those of us who are familiar with a Volkswagen Combi, I think the immediate images of a van, and the vast majority of us would not even think twice before writing the van benefit onto a P11D for such a vehicle. But and indeed, that is what Coca-Cola did. But HMRC decided that they weren't happy with the treatment of a van benefit going down on a P11D for a VW Combi, and took Coca-Cola to court and won. And actually had the VW Combi classified as a car. The mind boggles. And the reasoning for this is that in the legislation, a van is defined as a vehicle that is predominantly designed to carry goods. Now, the VW combis in question in the Coca-Cola case had been modified to an extent that they had 2 rows of seats in the front carrying passengers, and then the rear end was designed for the carrying of goods. And as it turned out, the space taken up by the passengers was equal to the space taken up for carrying goods. And because it was equal, it was determined that it wasn't predominantly for carrying goods, it was equal between the split of goods and passengers, and therefore, for P11D purposes, the vehicle was a car and not a van. Now, the impact for the employees in question is that instead of having the van benefit on their P11D, they have a car benefit. The car benefit is, of course, calculated in a very different way to a van. The van is a flat rate charge, whereas the car charge is based on the list price of the vehicle and the CO2 emissions. And for a VW Combi, those CO2 emissions are quite high, and therefore the taxable benefit on a P11D is much higher if a VW Combi is classified as a car than it is for a van. The knock-on effect for the employer, of course, is that they have to pay a lot more employers' national insurance as well. So bad all round if your van is classified as a car and not a van. Because of this case, the advice is that if you're preparing P11Ds this year, or indeed you operate vans in your fleet, you must make sure that you check whether your vehicles would stand up to a HMRC inspection. If an inspector had a look inside your vehicles, would they look at it and say, this is equally designed to transport passengers as it is designed to transport goods, and therefore we want to classify it as a car? If you think that might be an issue, then potentially need to look at whether you can redesign the seats or even look at replacing your van fleet. In the short term, you may also have to actually declare these vehicles as a car and not as a van. And if you need any advice on that, of course, get in touch. But it's quite a big case and a bit of a surprise, really, that a VW Combi can be a car and not a van. The next thing to talk about in vehicles, a bit more positive, is should we be considering buying an electric car? Electric cars are becoming a lot more fashionable now. And if you were to buy a brand new fully electric car through your company, then there are some significant tax advantages to be had. First of all, the car would qualify for 100% deduction against your profits in the year that it's purchased. That means that whatever you pay for the car, you can write that all off against your profits for corporation tax purposes. So if you spend £80,000 on a brand new electric car, that's £80,000 coming off your profit. That's true if you pay cash, or even if you finance the vehicle through, for example, a hire purchase agreement. The other side of any company car, usually these days, if somebody says, should I buy a company car? And they're looking at something that's got fossil fuels in it, petrol or diesel. The answer is usually no, unfortunately. You shouldn't buy it as a company car, you should buy it personally, because the income tax charges are quite prohibitive to it being advantageous to have through the company. But with a fully electric car, the tax charge on your P11D this year is only 1% of the list price of the car, likely to amount to a tax charge of maybe only a couple of £100. And next year, it'll only be 2%. There'll be a small rise, but again, it should stay in the hundreds of pounds in terms of tax charge, which is nothing compared to the savings that you would make. For example, if you were to try to finance the purchase of an £80,000 car personally, the potential additional drawings you'd have to take and the income tax on those would far outweigh the benefit in kind charge that you'd have to declare on a P11D. And finally, we're all fairly used to the fact that if you put petrol or diesel into your car through the company at the moment, there's a very prohibitive tax charge attached to that, unless you do some very significant mileage. If you have an electric car, fully electric car, and it's charged at a company charge point, or even if the company pays for it to be charged at one of the pay per charge points that you have dotted around the country now, then no P11D charge at all arises on that provision of effectively fuel for the vehicle. You can do that without tax charge at all. So very attractive way to finance potentially the purchase of a new car, if that's something you're looking into. Finally, this month's quick tip relates to the 5% VAT rate for hospitality. This reduced rate applies to specific areas. So first of all, it doesn't apply to alcoholic beverages. So for those of you returning to the pub this week, or future weeks. Fortunately, we won't be paying any reduced VAT on beer or wine or whatever we buy. But what it does apply to is hot and cold food or hot and cold non-alcoholic beverages for consumption on premises in which they're supplied. It also applies to hot takeaway food, hot takeaway non-alcoholic beverages for consumption off the premises in which they are supplied. It doesn't apply to catering services. They still remain standard rated. But this reduced 5% rate applies until now the 30th of September 2021. From 1st of October, it's going to go up, but it's only going to go up to 12.5%. And that's going to last until 31st of March 2022. And after that, from the 1st of April 22, as things stand at present, it will revert to 20%. So for those of you supplying in the hospitality industry, very much make sure that you're only accounting for 5% VAT now, and make sure your systems are prepared to accept this new 12.5% VAT rate from the 1st of October. And for those of us on the consumer side of things, look out for hopefully some price reductions. Okay, that's it.
Okay, thanks for that, Mark. Is that VAT reduction enough to save the pub industry in the next sort of 6 to 12 months? I'm not convinced by that. We've got a handful. We don't have a huge amount of clients in the hospitality industry, but those that we do have taken out, a minimum a bounce back, and a lot of them have taken out CBILS loans. They've deferred their VAT. They've not paid their landlords. They've got balance sheets which are loaded with debt. And I really think, from a personal point of view, that the government could have done more for that particular industry. I know that there's local grants that have come out. Most of them have got the 12,000, which is the kind of the startup grant again. Very useful. Is that going to be enough though? If you've got 100 grand CBILS sat on your balance sheet, how many of those businesses are going to be looking at the balance sheet, all those debts, and thinking, is this sustainable? Can I pay this debt back? And the obvious choice for them, not choice, I guess, but they'll be looking at those loans and thinking, is the company sustainable? And therefore, is this going to be counterproductive? Would more generosity in those VAT schemes have resulted in those businesses continuing to trade foreseeable and paying those loans back? It'd be interesting to look at the stats, won't it, in the next sort of 12 to 18 months as to how many businesses in the hospitality industry failed and didn't pay those loans back. A lot of people aren't going to like the sound of that, but that's just the way it is. Okay, it's now time for AdminMin with Lee. Lee, take it away.
Hi everyone, and welcome to the new tax year. So, starting on that, we're obviously well beyond the 5th of April 2021 now, so it's open season in terms of getting in your tax return information. Mark will be a much happier guy, and the benefits to you will be that you get your tax liability well in advance of the January 2022 payment deadline. Very quick reminder that it's the 31st of July year ends. It's their corporation tax payment due on the 1st of May. For VAT, the usual, it's the 31st of March, period ends this time. They're due 7th of May. Don't forget the VAT deferment application deadline. That's the 21st of June. And we've also got the partial exemption calculations. It's their annual adjustment, March, April and May. I know a lot of people's percentages were skewed by COVID, and there is a dispensation you can claim from HMRC. With Companies House, we've got this anomaly come to light now. So it's the 31st of April and the 31st of July year ends that are due by the end of this month. And for payroll, don't forget it's the national minimum wage. It's the first month where that actually gets applied. And those deadlines we've previously talked about, the P60s are due by the 31st of May. And the P11Ds, again, if you can get that information in as soon as possible, the deadline for them is the 6th of July. Thank you, and I'll see you next time.
Okay, guys, that's all for this month's episode. We'll see you back in May, by which time either the weather is going to be nice, or on the 17th of May, you'll be able to go inside the pub and enjoy a pint instead of being sat out on the street freezing your whatnots off. Anyway, until then, bye-bye, everybody. Cheers, guys.
Cheers, bye.